Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is August the 16th, 2023. It is now 3:01 p.m. Central Time, about an hour left in the trading day for mortgage-backed securities and for bonds. Now, we've been talking about the last couple of days that we're going to be interested to hear what we get out of the Fed minutes. And then this is basically the notes from the last Federal Reserve meeting. And then we can see a little bit further into what each of the members were talking about and kind of where they felt things were going, whether they wanted to continue to increase the federal funds rate, whether they thought inflation was coming down, and a little bit more of looking into their heads. Now, here's the thing. Let's take a look and see. We did get those Fed minutes that have come out here, and take a look at the article that came out from CNBC. Fed officials see upside risk to inflation possibly leading to more rate hikes, the minutes show, the Fed minutes. Okay. So what they're saying is that the general consensus in the conversation and in reading the minutes from the meeting that they had together was that inflation was still too high and they were still concerned with it and they weren't seeing it come down fast enough. So if you are flying a plane and you want to land that plane and you're coming down, when do you pull up? Do you pull up when it hits the tarmac, when it hits the runway, or do you begin to slow your descent in order to put out the landing gear and come safely landing into the airport? So I want you to take a little trip with me and let's talk. Let's kind of act like we're the Fed here and how I see the Fed is acting. So you jump in the car with me because we are going to go to the lake. We want to head to the lake. We want to get there as soon as possible because we're going to have a great time. We got to get to the lake. So we've been told that if we go straight down the road in front of us, we go straight down the road, you will come to the lake. They didn't tell us how long the road is or anything like that, but just say, hey, it's right down the road. Just go straight down this road and it'll take you directly. It will dead end into the lake. So we get in the car and we start going down the road and we go, man, this is kind of a long drive. So I start pressing further on the gas. Now we're going 60 miles an hour, 70 miles an hour, 80 miles an hour. We get to 90 miles an hour and I go, man, where is this lake? And we really can't tell where the lake is because unfortunately the windshield is covered in cardboard. We cannot see through the windshield. All we can do is look out the side window. So we're going to go 90 miles an hour down a road looking out the side window, and I can see that we're still on the road, but I can't see where the lake is. And I'm going to know when I get to that lake when I look out that side window and I see water. Does that sound like a good plan for us to get to the lake? That is essentially what they are saying, is that they are going to not only keep the accelerator down, but they're going to press it even further. They're going to go from 90 to 100 miles an hour, even though the lake is getting closer. We are seeing it almost every reading that is coming out right now, readings, measurements that they're looking at that says that inflation is coming down. Some have come from 9 to under 3, some of the readings that we're looking at, and they're saying that it's not coming down fast enough, and they're going to continue to accelerate in this road to our lake that we're trying to get to. That is what I see is going on here, unfortunately. But guess what? They're the ones who make the rules. They're the ones who control the federal funds rate, and they're the ones that are going to also impact home loan interest rates and bond rates. So let's take a look and see where we are right now. Okay. It is currently, let's take a look here. We are down 25 basis points. Not a big surprise here, considering the fact that they're talking about increasing the federal funds rate once again. We did have a lock alert today, which means that some of our banks and other advisors mentioned that we should lock our interest rates ahead of possibly interest rates continuing to rise in the near future. Down 25 basis points on the day. You can see here we've been broken below this Fibonacci level, banged at this Fibonacci level that was at 97.563, and now we are somewhere in between these two. The 10-year Treasury up again 5, now at 4.26. Again, we don't ever want to see the 10-year Treasury over 4, and we feel much more comfortable if we were cruising at around 3, because in a traditional market, and we talk about this every once in a while, I want to put this out there. If you look at history and you look at mortgage-backed securities on a 30-year fixed mortgage in comparison to the 10-year Treasury, it usually rides at about 1.8% over the 10-year Treasury. 1.8, 1.2, 2.0, 1.7. So basically somewhere between 1.7 and 2.0, but usually floating around that 1.8. 1.8% higher than the 10-year Treasury. If we were at a 3, we would be at about 4.7 on our 30-year fix. So you can see that there's reasons why that is a much larger gap right now, but it still makes us want to see the 10-year treasury get down closer to 3.0 so we can start getting closer to that 5 range as far as home loan interest rates. All right, so what does that mean for our home loan interest rates as of this moment here? Let's go ahead and take a look at our Brent Bruce Daily, very well qualified 30-year fixed conventional home loan here, 800 FICO score, 25% down, best of the best. And while that is running, don't forget to give me a call to talk to your clients who are looking to purchase property. If they are anywhere in the states of Tennessee and California, why not give them lower interest rates than they're getting and talk to a professional that can help advise as to what is going on? Give me a call. So here we are. Today, the loan store is at 7.5% with a credit of 756. Again, we're talking 7.5 now, guys, not 7.3, not 7.25, 7.5 in order to get to a no point loan. Let's open this up and take a look and see what it's going to take to get down. For instance, I mean, 7.375 is only costing 256. So that's probably something more realistic to what I'd be advising a customer to go with right now, 7.375. If you want to get under 7%, get into that 6 handle, you're just over a point right now. If you want to get into the 5s, you're here. Man, look at this now. We were just talking not long ago about 3.8% to get to about a 6.0% interest rate. Right now we're at 4.3. So you can see that's been an increase again to the cost of getting under 6% on a 30-year fixed mortgage. So let's take a look here. All right, so again, 7.5 is where we are as of this moment. Let's close that up and take a look and see. We always want to take a look at United Wholesale. Why is it that we do that? Because United Wholesale is the largest mortgage lender in the United States. So right now, 7.5% is costing $637. If you want to get into that 6.999, it's costing about 1.25 points, 1.25% of the loan amount. And if you want to get to that 5.999, a little bit better than the last company that we looked at 4.165%. But still, we're talking 4%, guys. That's a long way away. So we definitely want to see things start to turn around and hopefully start getting some good news. Unfortunately, I don't see good news coming with the personal consumption expenditures report that's going to be coming out later in the month here towards the end of the month, only because while we probably will have a good month over month reading somewhere around a 0.2, unfortunately we're going to be replacing a very low number, which is going to leave a lot of room for our year over year reading to show increase. And that's what the Fed tends to be looking at right now. Again, they want to see what's going on a year over year readings and not really seeing the trajectory of what we're doing right now. Unfortunately, we'll see how that goes. The next time the Federal Reserve is going to meet is in September, and we'll also have to wait for those results before we'll know what's going to happen on the federal funds rate. Make sure that you like, subscribe, share, hit the notification bell up in the corner. Let me know your thoughts, and if you have any questions, I will talk to you again tomorrow.